Hello and welcome to the inaugural week ahead. Thank you for joining me. My name is Chris Pollock. I work at Edpace Trade, and I'd like to kind of run you through what we're expecting from the week ahead. As a trader, what we try to discourage everyone in here is to wake up, open your eyes, see a chart, click a button. Right? There's a lot more to trading than that, and this week is very much a week of two halves, and one where I will, with some conviction, tell you the majority of my trades will happen from Wednesday afternoon onwards through till Friday, with me doing very little, if anything, in the days leading up to that. But maybe one exception on Wednesday morning, which we'll get to. But let's focus straight in on the main course of the week itself, which is the Fed funds rate. The Fed rate decision, the FOMC meet on Tuesday and through Wednesday, and they let us know their rate decision, which appears to be finally a rate cut. Now, just to kind of give you a heads up on this for those who are new, this happens typically every 6 weeks, but this is a bit of a unique one. After the summer holidays, they've had a longer break than they would normally. And in fact, because of the election, there's a slightly, by a day, more than a 6-week break to the next one. So this is going to be quite an important Fed rate decision. And what we can kind of garner from this every single week that this occurs is that all the news, and don't be fooled by these high impact news events around retail sales tomorrow, unless it's something very abnormal altogether. I do not feel we're going to get real clarity on market moves this week until we get that Fed rate decision, and therefore keeping powders dry, trying to choose when to optimally trade is a great way of keeping you out of trouble when others may walk straight into and stand on those rakes. So today's a prime example, right? We have holidays in Japan and China, so volatility going into the morning was already low, and we had very little in the form of news through Monday. Often the case on a Monday, a very quiet day for data. Typically, tomorrow there is a little bit. We do have inflation data in Canada and retail sales out of the US, sadly, simultaneously. And the often leaked German ZEW or ZEW numbers are another one I don't tend to look at because often get hold of this a little bit quicker, the right people. So these figures really for me aren't too interesting, which is why we're going to spend the majority of today talking about Wednesday. And before we get to the main event, we do have UK CPI out on Wednesday morning. Now, this is a figure over the last couple of years, which has arguably created some of the easiest moves that we've seen in the market. Typically on the FTSE 100, the pound, as is often the case with data releases, currency can reprice incredibly quickly. So unless you're running pretty low latency algorithms, you're going to struggle to get great execution on those sort of trades. However, the indices tend to be that little bit easier. If we're going to get a large move, the indices have been one of the places where you can get that early fill and run those trades that little bit longer, certainly for half an hour or so. And then often again on the open, we've seen if we were to get a significant deviation from the expectations on Wednesday. So those expectations are at 2.2. Sadly, we've had quite a few of these close to expectations of late. It's a little while now. These are all 0.1. There's a 0.2 miss there in May. The rest of them are all 0.1 misses. A long time ago since we were having 0.4 misses here, a few 0.3s knocking around as well. But if we were to get, and inflation is starting to choke up again, I think, right? We are starting to get some signs of inflation with the kind of the Baltic Dry Index, and a few other indicators suggesting inflation may be starting to tail up again. This may be a figure worth paying attention to, as I say, typically for the FTSE rather than for the pound, albeit the pound will move. It may just be harder to execute. So if you like trading data live, the FTSE may be smart on this one. If you like trading after the event, I'm sure if you're looking at some key liquidity levels, the pound pairs will give you something to go at too. But all in all, I mean, if you're not around for this one, you could, in truth, I'm not even going to be in the office for the majority of this day. I'm very much getting myself prepared for what will be a huge night. So this is the Fed's rate decision, arguably the biggest event in the calendar. I know the work done by the Bundesbank is the high volatility events. This puts the Fed's press release in second place in terms of volatility, behind the non-farm payrolls, looking back over a couple of decades of data. But it's at least up there in the upper echelons of volatility. And this is a day where good traders tend to make money. And why? I think primarily because it's a level playing field. It's not a data release, albeit there is a interest rate decision. But it is also giving you a summary of economic projections. And what this includes is something called the dot plot. The dot plot is a very clear indication by Fed members, and I should have brought this up earlier, so forgive me, but I'll find out the Fed dot plot. So you can see an illustration of this. But this will be released at the same time as the rate decision at 7 o'clock on Wednesday night. The dot plot looks a little bit like this. We have, albeit this is from way back in time, but this points to where the voting members believe their interest rate decision will be at the end of the next 3 years and in the longer run. So this gives a view on where we feel the longer term and shorter term rates will lie. And this in itself can and does create larger volatility on the dot plot Feds, which are only every second Fed meeting. And therefore, these ones on Wednesday night will likely be something that you could trade at 7 p.m. The ones that don't include dot plots, I typically do not trade them at 7 because a lot of the fun, which we'll get to, begins when the big man, Jerome Powell, takes to the stage at 7:30. But at 7 o'clock, we are getting the rate decision, the economic projections, and a statement. Statement maybe explains a little bit about changes to the Fed funds rate and why the all eyes will be on the rates and on the projections. Now, it's a bit of an oversimplification here to see the forecast. Currently sitting at 5.5%, expecting a rate cut to 5.25, so a 25 basis point cut. If you actually look at the implied numbers from the Fed funds futures, you'll see that it's a little bit more nuanced than that. We actually have, as we sit now, a 44% chance priced in by the market of a 0.25 cut. So that's a reduction to 5.25. But actually a slightly larger expectation that we're going to see a 50 basis point cut. That's a cut to 5%. So at the moment, this is where the market is pricing things in. Which is perhaps why we've seen the stock markets do pretty well of late, which we'll get to in a moment. But if you look at what's changed, last week there was only a 30% chance of this outcome, vis-a-vis where we are now at 56. So there's been a significant change, perhaps due to the inflation figures that we got through last week. The Fed is very data dependent, as they often like to tell us. And last week we did have that slightly frustrating core CPI figure that came in a little bit hotter than expectations, popping back to 0.3. Hasn't seen a 0.3 read since May. So that was a little bit concerning for the Fed, especially because they care more about the core than they do the headline CPI, or at least that's what they tell us. So, yeah, running through the predictors here, I mean, it's pretty much in the balance here. So it's not just a case of seeing the economic projections, or more specifically the dot plots. I feel like there is potentially a trade on whichever way this goes. There's going to be potential for volatility, whether we get the 0.25 or 0.5. If there is confusion in the markets, whether we're going to get one bit of data or another on a rate decision, then that can create real volatility. And just look down the list here and on the history of this. Only once during this rate hiking cycle did the market not call it absolutely correctly, or should I say, Forex Factory on this occasion call it correctly. And if we are going to get a cut to 5.00, then this will be another one. And these are the ones where the volatility really, really kicks in. So 7 o'clock is potentially a time to trade on Wednesday night. But as I've been alluding to, 7:30 is often even better. And that's because Jerome Powell, the chairman of the Federal Reserve, is due to release his press conference. And we'll just briefly touch on some of the things that go on during and at the end of his press conferences, at least recently, which are worth note. So very often, Powell arrives at 7:30. At some point between 7:30 and 7:35, the markets rally. Perhaps there's something in the statement they like. Perhaps it's his silver tongue. But the markets, the stock markets, tend to rally on Powell's chat. The other interesting thing is he normally kind of puts a pin, and there are chances for us to see some unusual comments made by him. He tends to be pretty by the book, but we will be listening out in case there are any tells, which can be very, very good to trade. As I say, a level playing field for point and click traders versus algorithms, I would argue. But the last two occasions, so the two previous Fed meetings, the moment he's put the mic down and left the stage, the markets have rolled over and sold right back to where they came from. So be careful with the Fed conference between 7:30 and 8:15. That tends to be when he packs it in. There could be a real spark in the market one way or another. Certainly more volume has kicked in at 8:15 when he puts the mic down. Why, I hear you ask? Well, perhaps they were waiting to see if there was going to be any more good news that he could give us, and there wasn't anything forthcoming, and perhaps that's why the market's been rolling over those last two occasions. That's hard to say, of course. They will do it again, but just an interesting one to see on the 8:15 print. But this 7:31, I would say maybe, yeah, 10 times in the last 12 meetings, we've seen 7:30, 7:35 rallies from there on. So bear that in mind on Wednesday. The rest of the week isn't quiet either. We roll straight into the Bank of England rate decision on Thursday, midday. So be aware of that one. The unemployment claims are very important at the moment, given the strange non-farm payroll figures and unemployment rate figures we've been receiving recently. So the unemployment claims are very much back in focus. I would be paying close attention to those. Existing home sales a little bit less. And to round off the week on Friday, the Bank of Japan. So the Bank of Japan are interestingly in a very different place to the Federal Reserve. The Fed of the Western central banks are up here at what, 5.5%, the larger than any of the European or Antipodean equivalents. Yet we're expecting cuts from the US. Japan has still barely got their rates above zero. Yet, although it's not priced in here, we're not expecting a rate hike necessarily, but rate hikes are anticipated in the subsequent meetings. And there may be something said about that in the monetary policy statement that comes through from the Bank of Japan. Unfortunately, we have this down as tentative, and they do keep us guessing. We've had a few occasions with people driving to the office for this where the numbers have dropped and missing all the fun. So many times from about 2:30, normally from 3:30, we hear from UADA and we get those Bank of Japan policy rates through. And then the press conference itself is a little bit more palatable for us European traders. Normally starts around 6:30. So maybe if you want to, think about the day ahead, maybe the 6:30 start on Friday might be one, rather than 2:30, maybe 3, maybe 3:30. Can be frustrating waiting there without a specific time. So one to think about on Friday. There are little bits and bobs of data rolling through, but the most important thing, bar the Bank of Japan on Friday, is the option expiry. And this is the quadruple witching option expiry. This is one of the big ones. The quarterly option expiry tend to are happening in March, June, September, this month, and December. And this 20th of September is when options stop trading for the month and for the quarter. So we do start seeing some, or often see some really interesting price action around these. The example I love to give people is with regards to COVID. You allow me to scroll back in time and take you back to 2020. Let's not think too closely about that, but let's have a look at the markets in that respect instead. But we knew about the Chinese virus, as it was called at the time, by a certain politician, and we saw the market kind of shake off some fears until we rallied up until, well, let's just quickly remind ourselves of when these option expiries occur. This is the third Friday of the month. August, third Friday of the month. July, you guessed it, third Friday of the month. This is consistently the third Friday of every month. We've scrolled back to this trend that we'd had, a lovely trend to new highs, albeit it's off by a day, but the third Friday of the month was the 21st of February, 2020. That was really the day before the beginning of the absolute washout that was the COVID-19 crisis. That in itself is fairly interesting. What's more interesting, we talked about the quarterly option expiries being the most important. Well, how long did this sell-off last? See the sell-off continuing. This Friday here was Friday, the 20th of March. This is a quarterly option. The market gapped open lower on the Monday. We rallied. We've never seen these prices again. So these turning points in markets tend to happen again and again and again. There haven't been too many great examples recently. The best I can find probably is this little sell-off that we had in April. We sold down to what was a low on what day is this? The third Friday of the month, before we turned around and rallied to new all-time highs and some. But seeing these quarterly expirations, there's some lovely examples last year, certainly on some of the pullbacks that we had. we look to the July period of 2023, and we see a lovely one. Well, the June one was excellent. This big rally, this price continuation into option expiry. We don't have too much time to go through as to why, but that's perhaps something you can reach out to us for. If you'd like to find out more about that, you can catch me on all the socials at C Volume Profile. But this rollover we had was started on the third Friday of June. Again, this big sell-off that we had, this was August 2023, the debt downgrade in the US. This catalyzed a big sell-off in stocks at the time. In the lead up to the third Friday of the month, it was down on the Tuesday, down on the Wednesday, down on the Thursday, Friday option expiry, the U-turn, and we rallied until the high, which was the third Friday of September, and we ended up getting quite the rollover in the end. So this, to me, is making me think trend continuation. Well, the trend is quite clearly being up, right, through the last week. Today, yeah, still relatively unchanged, off a few points here. Where did we open here? 22. So yeah, knocking 6 points off isn't going to do a great deal to that trend. I feel like there is a chance that we get trend continuation throughout the week, at least to the Fed, and who knows, maybe beyond. But then on Friday, that could be an opportunity for a little bit of a rug pull. The quarterly option expiries are often worth paying attention to. So that runs through the week for you. A pretty exciting one. Just to recap, don't go too big Monday, Tuesday, or even early Wednesday. You point your bullets towards Wednesday evening, and thereafter, I feel like you'll come out with a little bit more success than those who tried to make things happen in a market which is waiting for something else. All right, well, thank you for joining us. As I say, I'm Chris Pollock. Do reach out to us if you have any further questions, and we'll be back next.